Okay, so let's start today with a mental exercise that honestly makes my palms sweat a little bit just thinking about it.
Oh, yeah.
Yeah. Imagine you are responsible for a portfolio with nearly $17.5 billion.
Right. Which is,
That's a billion with a B.
yeah, it's an amount of money that is just hard to even visualize.
It really is. And, you know, standard financial advice, the stuff you hear in the news or read in textbooks, it says you should diversify, right?
And spread it out.
Exactly. You spread that wealth across hundreds of stocks, you buy the S&P 500, you play it safe so you don't lose your shirt.
Right.
But imagine instead, you take nearly 90% of that massive fortune and you shove it into just 5 companies.
5. That is what we in the industry politely call high conviction.
High conviction.
Or, if you want to be a bit more cynical about it, aggressive concentration. It's basically looking at the concept of volatility and just saying, yeah, I don't care.
Well, that is exactly the scenario we are unpacking in today's deep dive. We're looking at the latest 13F filing.
The one that dropped on February 17th.
Right, February 17, 2026. This is for H&H International Investment, which is the fund managed by the legendary Duan Yongping.
And for those listening who might not know the name, Duan Yongping is just a fascinating figure.
Yeah.
People often call him the Shadow Buffett. He is a Chinese entrepreneur who turned into an investor. He built massive consumer electronics empires.
Like Vivo and Oppo, right?
Exactly. But as an investor, he follows Warren Buffett's philosophy almost religiously. The core tenet being, buy what you understand, buy great businesses, and hold them forever.
But here is the thing, though. When I'm looking at this filing, it feels like he's taking Buffett's rulebook and just rewriting it for the AI age.
Yeah, he's definitely modernizing it.
Because he isn't buying Coca-Cola and American Express here. He is effectively putting all his eggs in one basket and watching that basket like a hawk.
It certainly looks that way. And to get a handle on just how concentrated this really is, we ran the numbers through our internal models.
Which is a heavy lift.
It is. And actually, just a quick note on that for you listening. If you want to access the same advanced research tools we use, including our latest published personal intelligent multi-agent deep value intelligence, welcome to subscribe on deepvalues.ai and research.deepvalues.ai.
Yeah, it's a total game changer for digging through all the noise in these massive filings.
It really helps parse the data.
Absolutely. And while we are talking about tools, if you want to track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store. It gives you a great macro view to pair with this kind of micro-analysis.
Which I think brings us to the mandatory housekeeping before we completely dissect this $17 billion bet.
Yes, the disclaimer time.
Let's get through it. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations.
Right.
All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
Always do your homework.
Exactly. And if you'd like to access wider topics, including life and investing philosophy, please subscribe to our sister channel at Deep Values.
Okay, so formalities aside, let's get into the actual numbers because they are, frankly, staggering.
They really are.
The portfolio grew from roughly $14.6 billion to $17.49 billion. And that was in just one quarter.
Q4 2025.
Right. That is a massive jump.
It's nearly a 20% increase in 3 months. That beats the index handily.
But the thing that really jumped out at me was the concentration score mentioned in our source materials.
Huh.
The, what was it? The Herfindahl-Hirschman Index?
The HHI.
Yeah, the HHI. It scored a roughly 3107. Now, I know that sounds like SAT math, so help us visualize what a 3107 actually means.
Okay, let's use an analogy. Imagine a standard index fund is like a massive cocktail party with 500 people.
Okay.
It's loud, it's chaotic, but if one person leaves, the party keeps going. Nobody really notices. That's a low HHI score, close to 0.
Makes sense.
But Duan Yongping's portfolio, it's a dinner table with 5 people.
Oh. So if one person leaves, the dinner is ruined.
Or at least the conversation gets very awkward, very fast. A score of 300 and 107 screams extreme concentration. When you look at his top 3 holdings alone...
Apple, Berkshire Hathaway, and NVIDIA.
Right. Those 3 make up 78.6% of the entire $17 billion pot.
That is wild. Almost 80% in 3 names.
Yeah.
This clearly isn't a portfolio for the faint of heart.
Definitely not.
I mean, it minimizes the risk of not knowing your companies because you only have to study a few of them deeply.
Exactly.
But it maximizes what the pros call single-name drawdown risk.
That's the trade-off right there. If one of those 3 catches a cold, the whole portfolio gets pneumonia. But Ron is betting that his immune system, like his deep knowledge of these specific companies, is just better than the markets.
Okay, let's talk about the anchors first. The biggest slice of the pie is still Apple.
The undisputed king of this portfolio, Apple sits at 50.3%.
50.3.
Yes, that's $8.79 billion in one single stock.
But here is the twist that the sources highlight. He actually sold some. He trimmed the position by about 7%.
Yeah, selling roughly 2.4 million shares.
Now, playing devil's advocate here,
There you go.
if he loves it so much that it's half his fund, why sell? Is he losing faith in these iPhone supercycle or something?
I really don't think it's a loss of faith. When a position balloons to half of your total assets, prudent risk management kicks in almost automatically.
Right.
You have to remember, Apple is a massive, mature, compounding machine. Our sources note it as a hold. It has an extraordinary moat.
The ecosystem, the switching costs.
Exactly. But the valuation is getting tight. To justify the current price, you have to assume some very aggressive growth assumptions regarding their AI integration and per-share compounding.
So he's just taken some chips off the table, maybe to fund other bets.
Likely portfolio rebalancing, yeah.
Which brings us to his second largest holding. And this one genuinely surprised me. Berkshire Hathaway.
Ah, the BRKB shares.
Yeah, he didn't just hold this one. He bought nearly 2 million more shares.
A huge increase.
That's a 38.2% increase. It's now over 20% of the portfolio.
This is the Shadow Buffett living up to his nickname. But look at the strategic balance here. This isn't just hero worship, it's deliberate portfolio construction.
How so?
Well, Apple is tech-heavy, it's consumer-facing, and it can be volatile. Berkshire, it's energy, insurance, railroads, manufacturing.
It's the physical economy.
Exactly. It's the real economy. It's a barbell strategy. High-tech on one side, sturdy industrial assets on the other.
So it's a flight to safety and quality.
Correct. Berkshire is the ultimate compounder. By increasing the stake, he effectively dampened the volatility of the tech stocks he's buying elsewhere.
Oh, I see.
It allows him to be super aggressive with the rest of the money because he knows 20% of the fund is sitting safe in the fortress that Warren built.
Okay, you mentioned being aggressive. We have to talk about the main event of this deep dive.
The AI stack.
The AI stack rotation.
Oh.
Because looking at this document, it feels like Duan Yongping woke up in late 2025 and decided to bet the farm on the AI supply chain.
He didn't just dip a toe in, he did a cannonball.
Seriously?
The most shocking number in the entire document is NVIDIA.
NVIDIA. This is the one that made my jaw drop. He increased his share count by 1,111%.
Over 6.6 million shares bought in a single quarter.
That is nuts.
It went from a small sort of tracking position straight to his third largest holding. It's now worth $1.35 billion.
Hold on, though. I have to push back on this a bit.
Okay.
We call Duan a value investor, right? And value investors are supposed to buy dollar bills for 50 cents.
Classic Graham and Dodd, yes.
Right. But NVIDIA right now is priced for absolute perfection. It's trading at sky-high valuations. This looks less like value investing and more like FOMO, fear of missing out. How do you square that circle?
That is the multi-billion-dollar question. And the source material touches on this tension. If you look at standard metrics like price to earnings, the PE ratio NVIDIA looks incredibly expensive.
Insanely expensive.
But Duan doesn't just look at trailing PE. He looks at discounted future cash flows.
Can you explain that for the listener?
Sure. He is likely looking at the terminal value. If you believe, as he clearly seems to, that AI is a platform shift, something comparable to the invention of the internet or electricity, then the demand for compute isn't going to just flatten out next year.
It's going to compound, pal.
It's going to compound for a decade. He is betting that the earnings side of that ratio is going to grow so fast that the current price will actually look cheap in hindsight.
So he thinks the market is underestimating the duration of the growth.
Yes. It's not about book value anymore. It's about the intrinsic value of future cash flows. And he clearly sees NVIDIA's future cash flows as undervalued.
Even at these prices.
Even at these prices.
Yeah.
And he didn't stop at NVIDIA, by the way.
Right. He also bought Microsoft. Shares were up 208%.
Massive buy.
And he bought TSMC. Shares up 371%.
And this is where the strategy becomes crystal clear. Our sources connect these dots beautifully. He isn't just stock picking randomly, he is ecosystem building.
The AI stack.
Exactly. Think of it as a vertical stack. At the bottom layer, you have the manufacturing. That's TSMC. They're the foundry, the only ones on Earth who can reliably build these advanced chips at massive scale.
So they are the factory that makes the shovels for the gold rush.
Perfect analogy. Then you move up a layer to the brain. That's NVIDIA. They design the architecture.
Okay.
And then at the top layer, you have the infrastructure and the software delivery. That's Microsoft, with their cloud network and their partnerships.
So he bought the factory, the product, and the distribution platform.
He bought the entire vertical. And notice the timing. This is late 2025. He is willing to accept AI cycle volatility because he views this compute demand as a multi-year shift.
He's basically telling us that the AI bubble isn't a bubble at all.
Right, he's saying it's the new baseline.
But here is where I get a little confused. And the sources point this out too. If he is so bullish on the chip supply chain, why did he slash his position in ASML?
Ah, the ASML paradox.
Yeah. He cut the portfolio's position in ASML by 88%. For those listening, ASML is the company that makes the extreme ultraviolet lithography machines.
The machines that make the machines.
Right. You physically cannot make an advanced NVIDIA chip without an ASML machine. They essentially have a monopoly.
A total monopoly on EUV.
So if you love TSMC and NVIDIA so much, logic dictates you should love ASML. Why sell the monopoly?
It is arguably the most curious move in the entire filing. On paper, ASML is the ultimate wide moat business. But our sources speculate we have to look at the risks that don't necessarily show up on a pristine balance sheet.
You mean the geopolitical stuff?
Geopolitics and capital cycles. We're trying to stay neutral here and just report what the sources indicate, but ASML is heavily exposed to export controls and trade friction.
Between the West and China.
Right. If they are restricted from selling their top-tier machines to a huge chunk of the global market, their growth ceiling gets lowered.
Whereas TSMC is, well, they are in Taiwan, which has its own well-documented risks, but everyone needs their output right now.
True. But beyond the geopolitical angle, there's also a semiconductor equipment cycle argument.
What does that mean?
ASML is a capital goods company. They sell the machine once. NVIDIA and Microsoft sell the compute or the software continuously.
Oh, I see.
It's highly possible Duan sees better compounding velocity in the chips and software than in the heavy equipment hardware. Or, honestly, it could be simpler than that.
Like what?
He might have just needed the cash. Selling ASML was a way to fund that massive NVIDIA purchase. Liquidity is finite, even for a $17 billion fund.
That makes a lot of sense. You robbed Peter to pay Paul. And he also trimmed Alibaba and Occidental Petroleum, which seems consistent with that theory of just raising cash for the big AI bets.
Yeah, Alibaba was trimmed by about 7.8%. That indicates a hold or trim stance on the China consumer internet space.
Probably due to the competitive intensity there.
Exactly. And Occidental was a small trim, roughly 2.8%.
Now, I want to pivot to something that I think is really cool in this source material.
Let's do it.
Usually when we look at these massive hedge fund portfolios, we only talk about the titans, the Apples and the Microsofts. But there's a section in our report about a new bucket.
The speculative edge?
Yes. 3 brand new names appeared on his list. They are tiny less than 0.5% of the portfolio combined, but they tell a very specific story.
It's proof that even with billions anchored in Apple, Duan is still hunting. He is still doing deep research into niche players.
First up is CoreWeave, ticker CRWV.
CoreWeave is a fascinating bet on AI cloud infrastructure. They aren't trying to be Amazon AWS and offer everything to everyone.
Right.
They focus specifically on high-performance GPU computing for AI workloads. But the sources note the risk here is the incredibly high CapEx needs. They have to buy all those expensive NVIDIA chips to build out.
But if they carve out that niche, it's huge.
Huge upside.
Then there's Credo, CRDO.
This is a pure bet on high-speed connectivity.
The plumbing?
Exactly, the plumbing. If you have thousands of NVIDIA chips trying to communicate together in a massive data cluster, they need to talk to each other at light speed. Credo makes the technology that allows that data to flow without bottlenecks.
It's the nervous system for the AI brain.
Spot on.
And finally, Tempus AI, TEM.
This represents the application layer. This is a bet on healthcare AI and precision medicine.
So using AI to parse medical data.
Yes. So look at what he did here. He didn't just buy a tech ETF. He bought specific targeted solutions within the ecosystem.
Yep.
Cloud infrastructure with CoreWeave, connectivity with Credo, application with Tempus.
He's planting seeds.
He knows some might fail, but in venture-style bets, you only need one to become a 10-bagger.
Okay, so let's zoom out for a second. If I'm the listener right now, just a regular person trying to make sense of the market, what do I do with this info? Because, frankly, copying this portfolio structure seems completely suicidal for a normal person.
Oh, please do not copy-paste this portfolio.
Yeah, let's walk through the risks.
The risks are glaring. First is the concentration risk we talked about. If Apple sneezes, this portfolio catches a cold. You do not have the buffer of 100 other stocks to save you if one company makes a bad strategic misstep.
And then there's the correlated risk.
That's the silent killer. Apple, NVIDIA, Microsoft, and TSMC, they are all currently riding the exact same wave.
They depend on the same global liquidity and the same AI CapEx cycle.
Right. If the AI bubble does burst, if enterprises decide the return on an investment isn't there yet and they stop buying chips, all of these stocks will take a massive hit at the same time.
It's not real diversification if everything moves in sync.
Exactly. And we cannot ignore the geopolitical risk.
Exposure to China and Taiwan.
Yes, via PDD, Alibaba, and crucially, TSMC. Any escalation there is a direct existential threat to a massive portion of this portfolio's value.
So if the lesson for the listener isn't to copy the trades, what is the takeaway?
The takeaway is the philosophy of competence circles. Notice what Duan Yongping invests in: consumer electronics, internet, chips.
Things he knows deeply.
He knows these fields cold. He doesn't chase trends in sectors he doesn't understand. You don't see him randomly buying pharma startups outside of that small Tempest AI bet or chasing regional banks.
He stays in his lane.
He stays where he has a distinct edge. And the second major lesson is about how you define value in today's market.
This goes right back to our debate about NVIDIA being a value stock.
Right. A lot of people still think value investing simply means buying stocks with low PE ratios.
Classic cigar butt approach.
Yes, picking up a discarded cigar butt that has one free puff left in it. But Duan shows us that real value isn't just low multiples. It's about buying future cash flows for less than they will ultimately be worth.
It's the difference between price and value.
Precisely. He is underrating a business reality that he fundamentally believes in.
You know, as we wrap up this deep dive, I'm struck by a final sort of provocative thought.
Let's hear it.
We keep calling him a disciple of Buffett, a classic value investor. But looking at this portfolio today, NVIDIA, Microsoft, CoreWeave, it honestly looks like an aggressive tech growth fund.
That is the big shift, isn't it? Our sources hint at this evolution. Perhaps in 2026, the definition of value has fundamentally shifted to growth at a reasonable price.
Right?
GRKP. In a world totally dominated by technology and intangible assets, if you rigidly stick to the old 1950s definition of value, just buying low book value companies, you might just get left behind. Duan is showing us how to evolve without losing the core principles of concentration and deep understanding.
It is a fascinating evolution to watch. We'll definitely be keeping an eye on his next 13F to see if he holds on to that massive NVIDIA stake or if he flips it.
I wouldn't bet against him holding it, honestly.
Before we go, a quick reminder for everyone listening. Don't forget to like this video. Much appreciated. It really helps the channel.
And remember, for those deeper insights, subscribe to deepvalues.ai for the intelligent multi-agent tools we mentioned, and search for the Buffett Indicator app on the Apple App Store to track that market temperature.
Thanks for joining us on this deep dive. Keep learning, stay curious, and we will catch you on the next one.
Goodbye, everyone.